Trump's tax overhaul, immediate relief, long-term concerns. Overview. Rising Treasury yields due to fiscal worries. Tax bill anticipated to slash tax revenues by $4.5 trillion over 10 years. Expected to enhance corporate profits and elevate stock values. From New York, July 3rd, Reuters. President Donald Trump's comprehensive tax cuts and spending package, which Congress approved on Thursday, sidesteps the imminent threat of a U.S. government default, but unfortunately deepens the country's long-term debt challenges. The Republican majority in the House gave the green light to a bill that will continue Trump's 2017 tax cuts, allocate additional funds for border security and military needs, imposed significant reductions in Medicare and Medicaid, and dramatically increase the national debt. Trump is anticipated to sign this legislation into law soon. Here's where it gets intriguing. As part of this tax initiative, legislators increased the US government's borrowing ceiling by $5 trillion, postponing the deadline when the Treasury would be unable to meet its financial obligations. This measure alleviates fears of a potential default on US debt. However, looking ahead, the long-term implications of this bill aren't as positive for the US bond market and the nation's fiscal stability. Estimated by nonpartisan analysts, this legislation is set to add $3.4 trillion to the national debt over the coming decade. This increase could amplify worries about the supply and demand dynamics for US Treasuries, which are vital to financial markets. And this part is crucial. According to Mike Medeiros, a macro strategist at Wellington Management, this legislation intensifies the structural issues surrounding Treasuries, particularly ongoing fiscal deficits and high debt levies, along with inflation concerns. BlackRock has already voiced caution about foreign investors growing hesitant towards American debt. They point out the risk of decreased demand for the new $500 billion in debt issued weekly by the US, potentially leading to higher borrowing rates. But here's a contentious take. A tax bill, by cutting tax revenues by $4.5 trillion and reducing government spending by $1.10 trillion, also removes insurance coverage for 10.9 million people on federal health insurance in the next decade. A decision that will certainly stir debate. On the flip side, it promotes business growth by allowing companies to deduct full expenses on equipment and research and development, plus other tax reductions. What do you think about the future economic landscape? Some investors already concerned that the debt burden might limit the positive economic impact the tax bill aims to achieve. A point to mull over as we consider long-term fiscal strategies. In the meantime, the tax bill's passage didn't significantly shift the bond market's reaction, as many had already anticipated the resulting deficits. Attention remains on other economic indicators like the S&P 500 index's record highs and the Federal Reserve's interest rate strategies. What's your take on the balance between immediate fiscal relief and long-term risks? Share your thoughts with us in the comments.